I mean, that stuff's just completely foreign. It's all brand new concepts. So partnership, ordinary income or loss. So we got two different types of income. We've got ordinary income, which is the income or loss that's generated from our ordinary operations, right? If we sell widgets, then the costs involved with selling widgets and the income that we receive from selling widgets is part of our ordinary income. If we decide to invest some of our profits in Bitcoin, and we, well, you don't have dividends from Bitcoin, that's a bad example. We decide to invest some of our profits in a brokerage account and it generates dividends for us. Well, that generation, it's still income, but it's not really part of our ordinary income. It's not part of our ordinary operations, right? It's side money. So that money is reported separately on the tax return, first off, but also on the K1, and it's reported to, the dividends would be reported differently to individual partners. The ordinary income, though, is what, like on our Schedule C, it's what would show up on line 31, okay? So all of our income, if we have cost of goods sold minus cost of goods sold, minus all of our deductible expenses, everything that ends up then on line 31. That's essentially what our ordinary income is for a partnership return. Now there could be a loss as well. We could generate a loss, and whether or not that loss offsets other income is dependent upon the individual partners and their outside basis in the partnership. Okay, and we'll talk a bit about that I don't think we talked about it in this section, but we will talk about how that all works. But so the partnership calculates ordinary income and loss, reports the amount on page 1 of the 1065. Again, this is similar to how a Schedule C would also report all of that income and expense. The depreciation methods are the same. The tax rules are all the same, right? A business is a business. It's just how it's all reported and kind of where it goes. But all of the tax rules that we talked about with regard to Schedule C businesses, same sort of rules apply. So same depreciation methods, same class law, asset lives, all of that stuff is all the same. There are a couple of items that are unique to partnerships though, that we need to talk about. One is guaranteed payments. I guess they got depreciation. Why are they mentioning depreciation? We'll find out why they're mentioning depreciation. I can't think of it off the top of my head. Health insurance premiums. Health insurance premiums for partners are treated a little bit differently, and we need to talk about those. So guaranteed payments. Partners do not receive salaries. They're not on the payroll. They don't get wages. They don't have withholding. Just like if you had a Schedule C, right? You don't have withholding, and you're going to have to pay your own self-employment tax if you're an independent contractor, if you're self-employed. Well, partners are self-employed, just like Schedule C business owners are. So that means they also have to pay self-employment tax, and they don't receive wages. Okay, they don't get those. They're going to pay tax on their share of the profits, just as though it was a Schedule C business, right? Whether they took money out of it or not, right? Schedule C business, you're going to pay tax on that line 31, the final line. You may not have taken any money out of the business, right? But you still have to pay tax on that. Same concept with regard to partnerships. However, they do have this special feature called guaranteed payments. Guaranteed payments are payments to partners that sort of act like a salary. The benefit of the guaranteed payments is that the partnership actually gets to deduct them from their income. Now, the partner has to pay tax on the amount that they receive, And there are certain restrictions on guaranteed payments. The word guaranteed is important here. It means that the partner has to receive these payments regardless of whether the partnership made money or not. It cannot be dependent on the income of the partnership, just like any other wage, right? Also, it can't be dependent on, oh, okay, we're gonna pay you 10% of our net income. No, it has to be a set amount and issued on a regular basis. So these are payments made to partner, and it's in exchange for services as well. So to qualify, the payment has to be calculated without regard to income. Here we've got Junius, 20% partner in DJ Real Estate Partnership. He does work for the partnership, receives $1,000 a month for his services. $1,000 a month is considered to be a guaranteed payment. The partnership can deduct it from their ordinary income, but Junius is going to have to include the $12,000 as income on his individual tax return, and it's going to be subject to self-employment tax, which, by the way, for partnerships, all of their ordinary income is also subject to self-employment tax, just like ordinary income from a Schedule C business. So we've got Donna, 80% partner in a real estate partnership. She works for the partnership, receives a monthly payment of 50% of the net income. This is not a guaranteed payment because it is dependent upon the income. She's going to get 50%. That would be considered a distribution. It would be treated differently. We're going to talk about distributions in a future section here. These are the only items that can be reported both as a deduction for ordinary income and as a separately stated item. So how this works, let's say we've got a partnership, their income is $100,000. Let's say there's two partners. Their expenses are $50,000. And then they paid a guaranteed payment to partner one. Only to partner one of $10,000. So their ordinary income, this is the ordinary inc. This is the partnership, is $40,000. So they get to deduct that $10,000 from the ordinary income. Now we've got two partners and they're 50-50 partners. Partner one has $40,000 of income, ordinary income. Partner two has $40,000, I'm sorry, $20,000. Of ordinary income. But in addition, partner one has this guaranteed payment of $10,000. Partner two doesn't have that because they didn't get a guaranteed payment. So that guaranteed payment is reducing partner one's ordinary income by half of, $5,000, but they're gonna have to pay tax on the full $10,000. So so partner one is gonna pay tax on $30,000 and is gonna be subject to self-employment tax as well. Partner two is gonna pay tax on $20,000. That's gonna be subject to self-employment tax. So it gets deducted up here before the net income is determined. And then once it's distributed, that guaranteed payment is added to whoever earned it. Does that make sense? Let's see. This is what the 1065 looks like. I'm not going to go through line by line, but you'll just notice that it's very similar to the Schedule C. So all of our income up here, cost of goods sold, gross profit, all that stuff, total income, all of our deductions, guaranteed payments to partners listed there, that's where it's going to be subtracted in order to calculate what our ordinary income is. Line 23, ordinary income or loss. So this is the amount that's going to get distributed to all the partners. So that would have been this 20,000 here. Yeah, don't worry about all that stuff. That's very confusing. There's some intricacies to partnership income for sure. What type of partnership is it? You know, is it a limited liability partnership? I don't know what the difference is between a limited partnership and a limited liability partnership. No clue. Let's see. Did the partnership own 20% or more, directly or indirectly, or 50% or more of the voting power of all classes of stock entitled to vote in a domestic corporation? So if the partnership owns a corporation in certain percentages, you've got to report that, certain reporting requirements. Lots and lots of questions, yes or no questions that we don't really need to go through. Okay, this is the Schedule K on the partnership return. It corresponds with the K1. Schedule K in the partnership return reports the totals of everything that's going to be reported on all the K1s. So this is kind of like a summary of everything. Everything on this K1 is going to then get blasted out to each of the partners based on their ownership percentage. And you can tell, so ordinary business income, again, that's from page 1 up there. Rental real estate, these are all of our separately stated items. So our ordinary business income, one line, and then separately stated items down here. And like I said, then all of this stuff gets distributed on the K1s of each individual partner based upon their individual circumstances, like what their percentage ownership is. If they received distributions, those are going to be listed. Where are the distributions? Somewhere on here. Distributions of cash and marketable securities. Could be that some partners got distributions and some didn't. So that could vary per partner. All of those are individual items. Here's the balance sheet that has to be kept. This is the balance sheet per books. It has to then match the balance sheet per, well, I guess this is the balance sheet per the books. There's a reconciliation between this and then the tax income as well that has to be done. And that's usually, that's on the schedule M1. We're going to work more with this in the next chapter because there are M1s that are part of the corporate tax return as well. Let's see, what else do I want to say? Depreciation is the same. The 179 expense is a little bit different. The partnership can use the 179 expense, but the deduction cannot reduce the partnership ordinary income. The 179 expense, it has to be reported separately because remember we've got those limitations on the 179. Those are at the partner level, those limitations. And so the partners themselves have to report the 179 expense, and then it mixes with any other 179 expense that they have coming from other places. Okay, so that's being pulled out. That's what they meant when they were talking about the depreciation. Health insurance premiums. So these are only partnership health insurance, partner health insurance premiums. If the partnership is paying the health insurance for partners, that amount is considered to be self-employment income to the partner. They get then a self-employed health insurance premium deduction in the same amount up to the amount of income that they got from the partnership. Okay, so yes, the partnership can pay it on their behalf, but it's considered to be income. But then they turn around and deduct it as that above the line AGI deduction on their income tax form. Business interest expense, this applies to some companies, not, they have to have assets gross receipts, average annual gross receipts of over 29 million, what happens is that they're limited to how much interest expense they can claim as a deduction. So businesses with annual average gross receipts over $29 million over the last 3 years, business interest expense is only allowed to the extent it does not exceed 30% of adjusted taxable income. That's a separate calculation, the adjustment. We don't have adjusted gross income for these businesses, by the way. That's only for individuals where we have that adjusted gross income, but they have this concept of adjusted taxable income. So it just means that if they, if adjusted taxable income is $100,000 and the business interest expense was $40,000, they can only take $30,000 of it. So they're limited to how much interest expense they can take. All right, so this is just kind of a summary, and we're going to talk about separately stated items here in a minute. Ordinary income's the type of income and expenses that goes into ordinary income. So gross profit from our regular operations, right? Any ordinary income from Form 4797, so that's for sale of assets. Remember from Chapter 7. Salaries and wages of non-partners. These would be deductions, obviously. Guaranteed payments of partners, repairs and maintenance, bad debts, rent, tax. This is just a list of different types of expense items that would be included. Of course, it's not exclusive. And then these are what are called separately stated items. I'm going to talk a little bit more about that in this next section. Separately stated items, so not part of this income. Again, all of these separately stated items are going to go on the K-1, and each individual partner, the treatment of it may be different on their individual tax return. That's why they're separately stated. That's why we have to pull them out, because of that treatment is different. If we combined it with all of this, we would never know. If long-term capital gains were mixed in with this, well, the individual partner is losing out on the advantage of that lower tax rate on the long-term capital gains, right? Because this is going to be taxed at a different tax rate. So that's what all these things are, items that would be treated differently. And then again, just kind of a list of all of that stuff. Questions about ordinary income?